Hi, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Charts and Chat for August 29th of 2022. Please see our disclaimer for important information. Well, as we get started this week in the chart pack, clearly we need to look back to the week just past. We had the Kansas City Federal Reserve Symposium in Jackson Hole, Wyoming. And that's typically a time where we hear from Federal Reserve members and the Federal Reserve Chairman. It's usually a time where we expect policy changes. And this year's event, what we got on Friday from Fed Chairman Powell, was a pretty blunt statement that honestly was fairly hawkish, saying that the Fed was going to continue to keep their foot on the accelerator for interest rate increases, that their goal was to fight inflation back down to its policy target of 2%. Obviously, we're much, much above that now, and so the market really took that on the chin. The S&P 500 was down 3.4% for the day. And in this tweet from Charlie Bilello, it kind of puts us in rarefied air. It's a seventh daily decline of 3% or more this year. And in the last 70 years, just reading from his tweet, the only years that we've seen more days with 3% downticks is in 2008, 2009, and 2020. And obviously, we know what happened in 2020. That was a pandemic. And then 08, 09 was the financial crisis. So again, we've had a lot of volatility this year, maybe a little bit less so lately because of this kind of building complacency, perhaps, that maybe some of the economy slowing down, and particularly with interest rates maybe slowing down or coming down a little bit off of their peaks, that the Fed would be less inclined to move forward. But the statement on Friday was clearly in opposition to that. And looking at this chart, we've shown this to you before, and obviously the first half of the year we had some data which showed the S&P was down 20%, bonds were down about 10%. Well, bonds really haven't regained any ground. Stocks have a little bit, but you can see here 2022 year to date here as we almost conclude August. The S&P's down 12% and bonds are still down around 10%. And just to highlight just extremely how unusual that is, S&P 500 down years are just taking a kind of a sampling here. And in every case, you've been able to get some diversification benefits from being in fixed income. And this year, that has not been the case. And just to kind of highlight the Bloomberg Barclays Aggregate index here on the right, it does have a little bit of price risk in it. And, the average maturity, or what we call in the industry duration, which is a measure of risk. It's kind of loosely tied to maturity, but it mathematically it's different. But it's a measure of risk, and the aggregate index has a longer duration, meaning more price risk than I think a lot of managers like us have been trying to position fixed income. We've been staying very short and trying to avail ourselves to higher rates as rates have moved higher. But again, the aggregate index is down 10%. That is, if we end the year this way, this will be an extremely unusual circumstance. Interestingly enough, this will be updated here, obviously, with the events of Friday in the stock market, but short interest is very low, which is interesting because, again, this goes to the theory that there's a little bit of complacency that has been built into investor sentiment, not consumer sentiment, but investor sentiment at least. A little bit more optimism built into stocks. And typically we see that short interest really tick up if the market believes that stocks are overvalued and poised for a large drop. Here's the probability of recession as dictated by the 2-year to 10-year Treasury spread. And you can see that lately that number has spiked up. We're over 50% recession probability within the next 12 months. I think there's a growing consistency in that regard, despite the fact that there's still some very interesting and admittedly positive elements to the economy going on right now. Now here's a quick chart on the 3-month Treasury bill rate. You can see here that we're pushing 3%, and this is the highest rate on the three month that we've seen since 2008. Here's the 1-year inflation break even. So again, looking at interest rates in a different light, the break even rate hit 2.45%. And that's the lowest since September of 2021. And you can see the trajectory on this moving lower after having peaked, at least, double this rate. But what this is really kind of telling us, and the bond market does a really good job, much better than the stock market does, of kind of foreshadowing, economic trends and whatnot. And as I've said kind of ad nauseum, it's not a matter of if we're going to have a recession, but really when it comes. And I think the Fed speak from Friday, might bring that to bear a little bit sooner than perhaps we thought, which, in many respects would be better, that we're not kicking that can down the road. But clearly what this chart is telling us is that the expectation within the bond market of slower growth, of slower inflation, of the Fed being successful in choking off this inflation is clearly now being priced into the bond markets. This is something I thought was extremely interesting from the Wall Street Journal. Back in 1995, and I was in the market in 95, and I remember the higher rates that we had back then. What was needed in terms of portfolio allocation to get a 7.5% return. And obviously back in then, when rates were higher, you could basically do that with bonds, and your standard deviation, or your volatility, if you will, was relatively low. That it was an easier time to manage balanced portfolios and be confident, at least in a return with manageable volatility. Well, as you can see from 2005 to 2015, that has changed dramatically because interest rates have come down. Now, obviously, they're higher than they were. They're off their trough, but as we just saw in that 2-year break-even rate, that the expectation is that rates are going to perhaps fall again at some point if we hit this recession, and particularly if we hit it sooner than we thought because of what the Fed was telling us on Friday. But with rates being lower, that puts a lot of pressure, more pressure on portfolios to generate the same level of expected return. And you could see the mix here of not only large cap equities, small cap, non-US, real estate, and then you see here in 2015 the emergence of private equity. And as a member of 2 institutional investment committees, a hospital endowment and a religious endowment fund, that both of which have moved very purposefully into private equity, and even into to some extent real estate through diversified products, if you will. But you can see that mix has changed, and diversification and asset allocation within the different sectors has become much more important. But at the same time, in an effort to generate the same level of expected return, you can see here, at least as measured by standard deviation, that the risk that you're having to take is almost 3 times as much. Here's a personal consumption expenditure price index, and this is what the Fed watches. So, and I kind of put this up here to kind of reflect on the comments from Friday from Fed Chairman Powell. It is their ardent desire to get that target back down to 2%. You can see that in the dotted line here, and you can see just how far away we are. And so this is why the market reacted the way it did. Now you've got a PCE all-in number, which includes food and energy. We know food is continuing to move higher. Energy may be abating somewhat, but If you back out food and energy, we do see that PCE, that personal consumption expenditures line, is rolling over. And so, how far does it need to roll over before the Fed really gets comfortable, even though they tell us they want it to go to 2? Can it fall to 3.5 and have them be comfortable with that? Now, those are things that we'll just have to find out. And obviously, the pace at which we get from where we are now, which is on this X food and energy, around 5%, the pace at which we go down will be important as well. Here's something that I've mentioned before, and in analyzing whether we have been in recession or not, there was some rather interesting debate going on several months ago, and you've heard me say that I felt like at one point that there was maybe a 25-30% probability that we were in a recession. But what we're finding here this year is this deviation between what I call gross domestic product, or GDP. That's what's very, you see that discussed in the financial press. That's what, when you talk about economic growth, that's what people are referring to. But there's also this notion, this concept of gross domestic income, and over time, these things should be roughly equal, and they're not. And so with gross domestic income really continuing to accelerate, wages are going higher, people are paying bonuses for new employees, and that gross domestic income line is meaningfully deviated. And you can see that in the right-hand chart. You can see it in the left-hand side where just lately, there's been a divergence between GDP and GDI. But you can see here on the right-hand chart that, and this goes back to the 1940s. So we've never seen this type of deviation. And so this is why I feel fairly convicted that we have not been in a recession, especially when you see income continuing to move higher. Now, we did get a revision in our GDP report for the second quarter, and this is normal. There's usually 2 revisions after the initial release that we get. And sometimes the changes are meaningful and sometimes they're not. In the release, the change in the release that we got last week relative to the GDP number that we saw at the end of July, basically it improved about 30 basis points, or 0.3%. You can see that in the red line. So granted, it was still, terrifically negative, but it was 30 basis points, or 0.3% better than in that first release. And so the difference in the August revision to the July initial report, you can see here, is primarily 2 things, and with a notable asterisk here. Inventories were higher than expected, and consumer spending was higher than we originally thought. However, the offset there is housing, and we'll have some charts on housing coming up that clearly show, the pace of the kind of moderation that we're seeing in the housing market. And here's a quick check-in on that. Again, we've got more charts coming, but housing contribution to GDP growth. When we talked about the pandemic year and prices moving higher, and this work from home idea, and a lot of people, there was a lot of mobility back in that year, and even heading into as we were heading into 2021. Now that has definitely slowed down, and so I just look at this, as kind of a bit of a ripple effect. You throw a pebble in a water, and you see these waves of ripples that eventually kind of attenuate and then kind of level out. And I think we're in that mode right now, where prices went up so much, and it was really an untenable rate of increase. And so at some point we knew that, that we were going to have this day of reckoning that I think we're seeing right now in housing. Here's a composite number of the Philadelphia Fed index, the Empire Index, Richmond Fed, Kansas City Fed. This is a composite of essentially multiple Federal Reserve branch surveys of activity. And so this is a manufacturing index of new orders. And you can see how activity has really slowed. And this is a diffusion index. So Obviously, everything that's positive is represents growth, and everything that's negative is the opposite. And in this time series, it goes back to 2007. You can see how this corresponded. These negative trends have corresponded with recessions, and a very tight overlay here, obviously in the global financial crisis. And we're seeing that right now. So again, as I said, I don't think we're in a recession right now, but I do think that the groundwork is being laid, and especially with the rhetoric from Friday from Chairman Powell, I think that recession may come sooner than we think. And again, I'm going to reiterate that I actually do think that that's a good thing. Let's get that behind us. Let's manage through it. Let's be very close in touch with the data, so that hopefully we don't make another policy mistake and go too far once we begin to eyeball, this recessionary environment. Here's some additional information from the Kansas City Fed, and I think it is helpful in two respects. One, we do see the average employee work week moving down. We also see prices paid moving down. So in the face of inflation, we do see employers kind of managing workloads, managing work weeks down a little bit, and to help them manage their cost structure. And good news here is prices paid is moving lower as well. So those are input costs. And so I didn't put the chart on here, but the prices received is also moving in a very similar direction. So this is all very consistent with an economy that's kind of just gearing down, that's pulling back from fifth gear to fourth to third gear. And we're just downshifting right now in a way that's very consistent with kind of pre-recessionary activity. Here's profit margins, and I've got two different slides on this. So the upper left, if you will, is the aggregate profit margins, and this is a trend dating back to 1950. And you can see, again, as we've said for many of these data series, that we're in kind of rarefied air. And so rarely do you see a recession, honestly, when you have profit margins that are this high. And so in the face of inflation, people have been able to get price because they're passing it along to their customers. And as we talked about in that last slide, prices paid for inputs are going down, and that means that prices received are moving down as well. So basically, companies are maintaining margins to a large degree, but I do think margins, I think at some point have to come down because if you sell less, then you have less opportunity to leverage fixed costs over time, and so when you have less operating leverage, that tends to reduce your margins. And so again, not a bad thing. You can see that we're witnessing extremely high margins right now. And then you can see in the lower right is kind of a purchasing manager index PMI composite overlaid with corporate profits. And you can see the purchasing managers index, again, just like we just saw, activity being lower. That number in the red here is moving lower. And so you'd expect corporate profits to move lower as well. Again, goes directly back to what I just said about, when you have less growth, less aggregate sales and activity, then that gives you less operating leverage to maintain those high margins, and margins are apt to come down. Here's a weekly average for the 30-year fixed rate mortgage, and you can see the trajectory here that we've been talking about quite a bit actually over the last several months. We saw a peak at around 5.8%. Then we saw some relief. We actually saw mortgage rates move slightly below 5%, but right now they're kind of holding in around 5.5%. Again, we'll have to watch and see what happens to the 10-year Treasury, which is where these 30-year fixed rate mortgages are indexed to, or in many respects are really kind of tied to. But expect to see fixed rate mortgage rates remain relatively high in this environment. So high rates have obviously contributed to, along with high prices, have contributed to this environment that we're dealing with in many markets of the country where affordability is just outrageous. It's certainly the case in our own backyard. What I thought was interesting here, and that Moody's Analytics shows us, is that there are actually pockets of the country, and there are certain pockets here in Central Texas, for those of you who are in this neighborhood, where prices have actually gone down on an annualized 3-month change through June. And again, not everywhere. There's still quite a few areas of the country that are experiencing outsized growth of over 12%. You can see here in the green, but you're starting to see kind of a spattering of these red areas, which represent net decline in prices. And here's a supply indicator for new single-family homes. What's interesting is, we've seen a really big spike. Now, there was a choke point, as we saw in roughly about a year ago or so. And obviously, there were prices were moving higher. There was a lot of demand. Building had not caught up, and then we had supply chain choke points, which prevented builders from actually getting product on the market, but that has changed now to some degree. And so you see that inventory number really spike. And so this is actually helping to moderate prices as well. Anytime you have new housing inventory spike like this, then it will mute your price impact of those homes coming on the market. Now, granted, existing home sales are much more meaningful to the residential real estate market than new home sales are. But the important takeaway from this slide, as I've shown you several other slides that are, what it's telling us is kind of foreshadowing recession, and this one is no different, that anytime you see these spikes in inventory, it's corresponded with recessions. You can see here in this chart from Charlie Bilello that 1973 to 75, and then 1980, 81, 82, and then the global financial crisis all corresponded with recession. Well, continuing our conversation in the housing market, you can see new listings of homes are down 15% year over year. You can see the trend line going back to looking at 2021 and 2020, just how much of a deviation we're in right now. So, we just talked about the new housing inventory being high. Now we see listings of homes, of existing homes, down 15%. So overall activity is really contracting here. And you see U.S. pending home sales on the right in contraction mode. Again, these are all areas that are consistent with the froth being taken out of the residential real estate market, which in many respects is good. But at the same time, it's showing us, and housing is really important to our economy. Shelter and owner's equivalent rent. We know rents are high, and the impact of OER on core consumer prices, is not insignificant at all. And so slowing in the housing market, I think, is giving us a real strong kind of real-time indicator of the breadth of the slowdown related to the higher rates, related to liquidity coming out of the market. Now, what's interesting is that we're seeing now a real spike in multifamily units, which is what we're looking at here. This is new privately owned units under construction for dwellings that have 5 units or more. So this could be a large condo development, but in many respects, it refers to high density multifamily residential, or AKA apartments. And so to combat this issue of housing affordability, this is kind of the natural response of things, that if you have renters in demand, you need more supply to help drive rental rates, down a little bit lower and improve affordability. So to wit, we're seeing this spike in multifamily development. Now we'll kind of migrate away on a few things here. We see the Fed balance sheet. Obviously, we've talked a lot about interest rates and the Fed's desire to want to keep raising interest rates, but there's really another side to this, and it's pulling kind of the punch bowl away, and it's taking liquidity out of the market. And obviously, you do that with interest rates and targeted, targeted short-term rates. But you can also do it by letting the runoff happen on your balance sheet. But you can see here, the Fed's balance sheet is still very high. Again, they just started this quantitative uh, tightening, if you will, this balance sheet reduction just a couple of months ago. And you can see that, I mean, we're basically about 1.3% down on the balance sheet. So we've got a long way to go in pulling liquidity out of the market. This is something I thought was very interesting from Refinitiv, from data from the New York Stock Exchange. And it just, it goes to show that, going back to, decades, this time series goes back to 1930, and the average holding period of stocks has really gone down, where it was, back in the day, not even well before my generation, you tended to hold stocks for multiple years. Like you'd hold you'd hold IBM or General Electric or RCA. You'd hold those for years and years, and a lot of these paid really decent dividends, and you just collect those dividends. And a lot of people retired on a handful of stocks because they didn't sell them; they held them. Which buy and hold is being taught in financial programs, but it's not being practiced nearly as much. You see, the average holding period is a mere months now, when it used to be measured in years. And so, you have a generation, actually multiple generations of really traders, and this is creating more turnover in the market. Obviously, we have less supply of stocks. The aggregate number of publicly traded stocks is much lower than it used to be, even 10, 20 years ago. But even within that, people are holding them for shorter periods of time, which is contributing to the volatility. And it's been a long time since I've seen a data point like this that kind of opened my eyes to where this inherent volatility could be coming from. Well, something I want to talk about is being discussed out there in kind of I'll call it the scientific community and the engineering community, but this will become a financial markets issue before too long. And so this is a capture of some data that I found not only from the International Monetary Fund, but I believe this is from the World Economic Forum, and it's actually from a Q&A piece that I read. But just looking at water, I mean, and we're seeing droughts all over the place now. I'm recording this after an evening here when in Cedar Park we had anywhere between 4 and 6 inches of deluge. But so irony aside, we've been in a major drought here in Central Texas, but we don't live in a microcosm. And obviously, a lot has been talked about with Lake Mead, and I've got a chart on that which will blow your socks off. But the western part of the U.S. is in a major drought, and you can see here that in Europe, China, all of these areas, and these are major economic engines, if you will, that are struggling with water. And think about how important water is for power generation, which powers the companies that make widgets. And in many cases, it powers the economic growth of these areas. So, in China, worst drought records since records began in 1961. Southern Europe, worst drought in 500 years. Drought in the American West, which began 2 decades ago. Just reading from this caption here, is the region's worst in 1,200 years. I just want to put everyone on notice that this is something that the financial markets are going to be dealing with in some degree in the years ahead. And here's that chart on Lake Mead, which shows you the water level in feet. And back in the 80s and 90s, even up to 2000, you could see water levels at 1,200, 1,225 at its peak. now down to roughly about 1,000. And so, when you talk about hydroelectric power generation, that's a problem. When you talk about just water supply for a growing economy, then that's a problem. Obviously, density is increasing in those areas, and water resource management is absolutely going to be a factor that is going to have to be considered on not only corporate relocation, but also municipal development and resource management for cities, towns, and even states and regions, and bubbling up to the country level as well. Well, a quick look in on some commodities here. We've got corn, soybeans, and wheat. So these are the edible agricultural commodities here. But we do see increases in corn as well. But right now we're just talking about the edible ag commodities. We did see a lot of relief earlier this year. Now those are beginning to perk back up, and admittedly this ties back to my last chart, and that some of these drought areas you're seeing less corn be planted just because of irrigation issues, and you see less. Again, some of this can tie back, particularly on wheat. It can tie back to Ukraine and the Russian invasion, but we've actually unwound a lot of those spikes that were tied to that. And you can see those spikes here. Earlier this year, and a lot of that was tied to Ukraine, but that has really cycled through now. But you're beginning to see that uptick that's really tied less to that geopolitical side and more towards the water management side. Well, here's crude oil, product exports, and then we've got stocks for oil and then gasoline. Right-hand side, left-hand side first, we'll talk about exports. So interestingly enough, with increase in production, so I haven't shown you the rig count, but we know that that's up. So we're producing more oil at a time where rates, prices are high enough that even with this strong fiscal discipline that's being shown by domestic producers, that it is just too much of an incentive for them not to be producing. But we're actually exporting more oil and oil derivative products. And you can see that very, very handily here on the left. Now on the right-hand side, this is actually from the Energy Information Agency, the EIA, and it shows you in that blue line for crude oil stocks where we stand relative to that shaded area, which is a 5-year trend line. And so we're at the lower end of that in terms of crude oil stocks. Again, I thought it was ironic because on the left-hand side, we're exporting more, so our crude oil stocks are lower than they otherwise would be. And then on the bottom right, we've got gasoline stocks, which are and have remained well below their 5-year trend line, which is important in considering the notion that we're going to continue to have higher gasoline prices for longer. Well, in our last slide of the day, we'll look at agricultural exports, and you can see here with commodities rising, obviously you've got Europe that is struggling because a lot of and actually the third world struggling a little bit because a lot of the exports that would otherwise come from maybe Russia and Ukraine. I mean, some of these are being disrupted, but that's not the only factor here. Again, this global drought is an issue. And so you see U.S. ag exports moving higher as well. So that's all we have in the chart pack this week. Hope you've enjoyed the chart pack. Let us know if you have any questions. Hope you have a wonderful week, and we'll talk to you again soon. Take care. Bye.